Hello, this is John Smallwood, and today we're going to be talking about the impact of taxation on compounding of wealth and volatility adjusted returns. It's going to be like a double-edged sword today to, again, learn more about what's happening as this financial pressure accumulates on our wealth coming in from multiple aspects. What we learned in the last category was that the $500,000 investment that grew at a 10.04% rate of return, which 20 years later was worth $3.7 million, when you factored in the volatility adjusted returns, that the amount of wealth that was created was reduced by almost $1 million, a little bit over $1 million, down to $2.7 million. Now the reality is, what we've done in the holdings is that we've broken the portfolio down into three components. And that when you think about a portfolio, there are dividends, there are interest coming in from, if you have bonds in the portfolio, there's qualified dividends that are coming in, there's realized gains that are either short-term or long-term, and then there's stocks that you hold that are unrealized. And what we've done, just for purposes of illustration, is we've broken this down into three components, saying each year there'll be some long-term capital gains realized that'll be taxed at a low rate. There'll be some short-term gains that'll be taxed at ordinary income rates, and there'll be some deferred gains not creating taxation in that calendar year. And what I'm going to do, just to make this simple for a second, is to allocate a very simplistic tax to both of these categories, where we say a 30% marginal bracket for the short-term capital gains and some of the interest income, and a 20% capital gain rate. And what we begin to see, again, we're assuming that the tax will get paid out of this account, that it's a closed environment here, is that the gap between the wealth that was potentially created of $3.7 million after the volatility adjusted returns were down to $2.7 million, and now after taxation, the wealth is down to $1.6 million, which is almost $2 million of wealth that's eroded over the time frame. So the impact of taxation on your portfolio is extremely important. How the portfolio generates income, when it gets taxed, how it gets taxed, is extremely important to the amount of wealth that you're creating over that time frame. And if you kind of look at this, what you're seeing is that the tax along the way is being pulled out of the portfolio, and that volatility and the taxation is just applying significant pressure, robbing almost $2 million from you, from what you were expecting. So if you're sitting back with your spreadsheet, and we've seen this, I got my $500,000 is going to grow to $3.7 million, and my retirement's going to be fine. Well, the volatility and the taxation has stolen $2 million, so now you've only got $1.6 million accumulated. You're about $2 million shy. What happened with the other goals that you had, weddings and colleges and second homes, etc.? They're being taken from these assets, and more pressure, more expenses along the way are going to provide more pressure to this portfolio. So that taxation of mutual funds and ETFs and separate account management and exchange traded funds, which is ETFs, and unit trusts, is extremely important in understanding the turnover rates and the factors that affect your portfolio, you need to look at portfolios not only on a market volatility adjusted basis, but also on a tax adjusted basis. And a plan, what you always want to be focusing on is, how do I reduce the tax? How do I reduce the risk? And the goal in reducing risk is to reduce the impact of the volatility adjusted returns. That's what we're focusing on. So hopefully you found this valuable today, and look forward to talking to you.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.